July 9th. And so the markets are back up and we're officially year to date back in positive territory. But again, just any news that has come out about lowering tariffs or new deals with countries. So the UK deal, the temporary deal with China. Sorry. uh, so the UK deal, the temporary deal with China to lower the 145 down to 35%. And then April inflation data came in at 2.3%. All this good news is building up, and that's why we've seen markets rally. So hopefully, as more deals roll in and we get lower tariffs across the board, it sounds like the bottom is going to be 10% for most countries. As we get those deals finalized, I think that could be potential tailwinds for markets. Anytime we hear the threat of amplified or increased tariffs, that's when we've seen the market sell off. And then lastly, to your question, how do we design the portfolio to kind of hedge against the uncertainty we're seeing? We do have investments internationally. We do have some alternatives like global infrastructure, private real estate that have done well. And here is a good reason why we keep that diversification. So on page 8, you'll see, it's been a nearly 17-year period that U.S. has outperformed international. This is the first year that international has actually significantly started to outperform the U.S. And so through Friday, the MSCI EFI, so that's Developed Markets International, is up 16.3% year to date. And so that excludes China. Emerging markets, which China falls under, up 10.1%. The S&P 500 through Friday was actually down slightly, 0.8%. Now, again, the markets are up 1.5% to 2% today on the back of the news over the weekend that we're extending that 50% tariff deadline for the EU till July 9th. The markets are back up. So we're likely slightly positive year in the US markets. But again, this is why we have that diversification. The big reason, outside of the new administration's policies, why the US markets have underperformed is the Magnificent Seven. So Tesla, Apple, and Alphabet are all down significantly over 10% year to date. And as a whole, those 7 companies that have led markets in 23 and 24, they're down on average, roughly 3 to 4% year to date. So they're a significant portion of the index. The S&P 500 is cap weighted, so the largest companies have a larger portion of the index. So anytime any one of those 7 companies underperform, it's going to drag down the markets overall. And on the right, you can actually see NVIDIA, one of the largest components of that, which has been the best performer in 23 and 24. If you actually just took that company out, going back to October of 22, and compared the US market minus that one company versus Japan and Europe, we would have actually underperformed those 2 regions. So that's the significance and impact that just one of the Magnificent Seven has had on our overall market. With that, we can hop into the report and I'll give you those numbers. And then I'll go back to the handout just for an update on one of your managers, American Funds Euro Pacific. But in the report, if you go to page 5, for the quarter, we were down slightly. So overall, the total plan was down 183,000 or 1.4%, in line with your strategic model, which was down 1.3%. And your best performers were, again, International Developed Market Index Fund was up 6.8%. Cohen & Steers Global Infrastructure Fund was up 5.2%. And that portfolio is roughly 50% US, 50% international. And then Sawgrass, your fixed income manager, was up 3.1%. Fiscal year to date, so we're halfway through the fiscal year as of March 31st, down 207,000 or 1.5%. Again, in line with your strategic model, which was down 1.6%. For the 1 year, so past 12 months, you still earned 738,000 or 5.9%. And again, right in line with your strategic model and ranked in the top 43rd percentile. So outperforming about 60% of your public pension peers across the country. Best performers for the past year, Global Infrastructure up 14.8%. Your S&P 500 Index Fund up 8.3%. Convertible 7.4%. And high yield up 7.4%. So if you look there, just on the 1 year period, again, some of those areas that we've diversified away from US global infrastructure, convertibles, and high yield, three of your best four performers for the past year. And then if we go down a little bit further for the past 5 years, despite all the volatility, whether it's the pandemic, inflation spiking and the market selling off in 22, or the current volatility of the market, you still earned 5.7 million or 10.2 on an annual base, 10.2% on an annual basis over that time period. So very happy with how the portfolio has performed. If we flip over to page 9, just a quick highlight of your current allocation versus your targets. So again, the gold bars there are your targets. Blue is where we're actually 31st. So again, slightly underweight US equities, which helped for the quarter while US markets sold off. Slightly point out here. The first one, Fidelity Small Cap Index. Somewhat surprised in the how poorly small caps did for the first quarter. So historically, when there's volatility from a global standpoint, like we're seeing with trade policy, there's less of an impact on small companies because they're more domestically focused. So very surprised to see that it sold off more than mid cap and large cap. I would expect we should see a strong rebound from small cap in the coming quarters, especially from a valuation standpoint. Large cap is still somewhat overvalued from a historical standpoint. Small cap is significantly undervalued to its historical averages. So eventually those valuations will matter. And so I would expect at some point we'll see small caps start to outperform. The other fund I'll highlight is the American Fund Euro Pacific. Again, for the quarter, it underperformed. So you can see versus the index, it was up 2.7. The index was up 7. That's why we've diversified almost 2/3 of it away to that index fund, the Vanguard FTSE Developed Markets. And so with that, if you go back to the handout, just want to give a quick highlight of American funds, why it underperformed for the quarter, and why our recommendation currently is just to remain patient. We'll consider changes next quarter if we see continued deterioration in their performance. But on page 10 of the handout, this is just a snapshot for the quarter of what went well and what didn't work for their portfolio. And so what I'll touch on here is two of their largest holdings that underperformed and caused most of their underperformance for the quarter. Novo Nordisk, probably a name you're not familiar with, but it's one of the largest pharmaceutical companies internationally. You probably know more so their drugs, Ozempic, Wegovy, and Rybelsus. They are the new weight loss drugs or diabetes drugs that are being used off-brand for weight loss. So they're one of the first to market with the weight loss supplements, drugs. Had huge runs in 23 and 24 based on that. Unfortunately, competition has caught up. Additionally, the Trump administration signaled that they were going to impose tariffs on pharmaceutical imports. We've seen some language come out from the administration that it may not be tariffs, it may be negotiating, most favored nation, so that where pharmaceuticals are charging less abroad, they will now have to charge those same prices here or raise their prices abroad. So we don't know what that's going to look like. But again, that impacts their revenue stream as well as their bottom line. On top of that, they're in late stage clinical trials for a new weight loss drug, trying to get ahead of the competition. Unfortunately, they had underwhelming results in that late stage trial. And so again, kind of the three-headed monster, all three of those things. In the AI arms race, we want to be ahead of those countries we're competing with. And so anytime there's tariffs talked about or export controls, again, that leads to a write down in revenues, projected revenues, as well as earnings. And so with that, they sold off for the quarter. So two of their largest positions underperformed for the quarter. On page 11, the reason why we're recommending patience, it's no surprise really since the start of the pandemic in 2020, markets have been a little wonky across the board. It's been very hard for active managers, international, US, you name it, to outperform their benchmark. So you can see here this chart on page 11. If you look down the first column, this is looking at the end of 2020 through March of 2025. American Funds has been one of the worst international managers, underperformed its benchmark by about 4% over that time period on an annual basis. However, if we kind of write off the pandemic period and we look at the past 2 decades, so from 2020 back to 2010 and then 2010 to 2000, they've been consistently one of the best performers in terms of international managers. So that decade from 2010 to 2020 outperformed the benchmark by nearly 2.5% on an annual basis, ranked in the top first percentile. Same thing for the decade 2000 to 2010, outperformed its benchmark by nearly 1% on an annual basis and ranked in the top 7 percentile. So again, I think buying a little patience, we'll consider next quarter if they continue to deteriorate from a performance standpoint, making some changes. But we've already carved out 2/3 of the portfolio and put in the index, which has done well. I would put money on them returning to their longer term averages of outperforming in the next year. And again, if we continue to see them significantly underperform, we would likely consolidate to the index and then bring a search in to potentially add a different active manager there. But as of right now, just recommending a little more patience. I think they're so no recommendations. Again, Capital City is going to rebalance as they see opportunities in this volatile market. So that cash underweight is a little bit overweight, is probably come down already. And would expect if we see any more volatile markets where markets sell off by 5-10%, they'll put a little bit more to work. So with that, I will conclude my report and just open it up to any questions you have about the portfolio or markets overall.
Anna, can you hear us? We can't hear you.
Can you hear me?
Yes, now we can. Go ahead with your
Okay, great.
report, please. Thank you.
Okay, so you should have in front of you the drafted ordinance that applies to all 3 plans to add in the partial lump sum option that we spoke about at our last meeting. The language is pretty self-explanatory, just gives the options 5, 10, 15, and 20% that will be paid under the normal form or optional form as per the section, the relevant section in the plan. This was recently sent to Patrick to get an impact statement for. Because our meetings were delayed and rescheduled, he hasn't had this request for long. So I'm sure it will not be an issue for him to have it before the next meeting. Once we get that impact statement, I can provide the necessary materials to city council and hopefully get this passed, as quickly as we can.
Okay, you're back.
Were you able to catch all that?
Most of it.
Okay. Basically, just to summarize, this is the ordinance that was requested, for all three plans. I submitted it to Patrick. He had previously, okayed the language. I submitted it to him, now that it's completed and requested an impact statement, which I think should be no problem for him to have ready for the next meeting. And once that gets approved, we can provide the materials to city council and hopefully get this passed as quickly as possible.
Thank you. Now they also have the letter for reminding them to do their Form 1.
Yes, just another reminder, your Form 1 is due July 1st. The form has to be done electronically, and from what I understand, once you fill out the form this year, the next time you fill out the form, everything that you entered should auto-populate. So moving forward, it should be relatively easy to get all your information in and submit on time. But if you have any questions, please feel free to email me and I will get you the help that you need.
Anything else?
That's it.
Thank you.
Thank you.
As there's not been a actuarial impact letter with this yet. Once we receive it, we assume that there will be no impact to the plan, so it should affect it. There should be no budgetary impact based on what the actuary says at all, so it should not affect anything. So then you have to make an attempt to fund it. Yes, we will need a special meeting to get these things approved, especially if you want to negotiate. Partial lump sum as part of your negotiations, and instead of it to the commission. So yes, there will be an emergency meeting as soon as possible. Yes, sir. Yes, that's already been done, but Anna, as far as I know, there's no ordinance been written for a fixed rate, has there?
No, there hasn't.
So we'll need to have a meeting to authorize you to draft an ordinance with a fixed rate for this plan, so we can get it to actual, so we can get it to the commission as soon as possible.
Exactly.
We'll do that. On the committee, she's the chair. Yes. Question if I can join. Thank you. will you be available on Wednesday, June 4th, to join remotely if there's a special meeting scheduled at that time?
Kyle, are you talking to me?
Um,
Okay, sorry, it's very difficult to hear. You said
It must be breaking up.
June 4th at,
1 o'clock?
yes.
I'll schedule a special meeting for 1 o'clock on Wednesday, June 4th.
Okay.
It's adjourned, Anna.
Thank you.